Welcome to the next episode of Lumida Non-Consensus Investing. I'm your host, Ram Alawalia, CIO of Lumida Wealth. I'm thrilled to be joined by a special guest, Jeff Park from Bitwise. So I first met Jeff, I think it was at the LW3 conference. I've been following Jeff for quite a while on Twitter. You should follow Jeff as well. And he was on a panel with three others. And I said, I got to meet him because he was just ahead of the rest and super dialed in, and we got to know each other. And we're going to talk about quite a few different topics today. We're going to talk about what Harvard got wrong, the Harvard endowment. We're going to talk about hot ball liquidity, talk about digital assets, talk about global macro. See if we can do that in the next 50 minutes or so. Welcome, Jeff.
Thanks, Ram. Happy to be here. And it's a real privilege to share this podium with you. I've also been a longtime fan of your output. I think when I discovered you was your authoritative research on FTX and amongst the other bankruptcies that you followed very closely. And to me, it was an incredible sounding board to confirm the way I was seeing the world. There were other people like you also corroborating on it. So funny to think all these years later, now we're here in a post FTX world.
It was fun riding on the way down and then getting back on the way up. So that was the key thing. So I'm sharing Jeff's just LinkedIn on screen here. So he was Stanford, then Morgan Stanley derivatives trader, senior associate Harvard Management Company, which is the company responsible for managing Harvard's endowment. We'll talk about their performance. Corbin Capital partner, Bitwise. So Jeff is kind of a slacker, is like one of the takeaways from all of this here. So let's start with Harvard Management Company. Do you want to introduce Harvard Management, who they are, what that experience is like, and let's talk about why their performance has been so lackluster.
Yeah, happy to do that. And it's timely because Bloomberg actually released a story not so long ago lamenting on Harvard's lackluster performance for the last decade plus. And it was actually a really good story. I thought it was well researched by the journalist in all the ways that endowment models can look different across the board in the United States. And a few exceptional circumstances, I think, relevant for Harvard's trajectory since. So let me kick it off by introducing HMC. HMC, Ram, as you said, is the Harvard Management Company. It's the entity that manages the Harvard endowment. And its stakeholders are the presidents and fellows of Harvard College, who has a board that, of course, looks towards ensuring that Harvard's performance is in line with other endowments and like-minded institutions. Harvard, as many of you may know, is actually the world's largest higher education endowment. And that means that they can do a lot of clever things that maybe other institutions cannot at that scale. So I'll give you a quick rundown on the history of HMC that may be useful as a context. HMC has a long storied history in which at one point in time, they were unique in their endowment model versus everyone else in the world, including the Yale Endowment. The Yale Endowment, of course, as spearheaded by all the work in which David Swensen promoted the ability to hold long-term assets is a good thing to increase allocations to private equity and venture and things like that was very significant. Of course, Harvard did some of those things, but the thing that Harvard did that was really different is they ran internal capital. They ran what I would today say a multi-manager business inside of Harvard. And that
like
was
a Millennium Pod.
That's right. Across multi-asset pod shop model within Harvard. And that was the team that I joined.
So liquid strategies only?
Yes. So we had a variety of PMs. They were hired from the buy side, sometimes the sell side, and they would trade equities, emerging market equities, rates, FX, credit. I was on the credit team where we looked at investment grade and high yield credit, as well as different asset-backed securities. And the vision was, if you could actually hire talented people to manage money for you in a capital efficient way, why should you actually pay 2 and 20 if you're the world's largest endowment anyway? And so when I joined Harvard, it was a huge organization. Actually, there was 200 plus people, and more than half of that was dedicated towards the effort of building out the operational technology, risk, infrastructure required to run such an operation. This also predates a time when the CIO used to be a gentleman, a superstar really, named Jack Meyer. And he really was the person responsible for setting this vision very early in the 90s and had stellar returns. And of course, he would go on to launch his own hedge fund called Convexity and do many great things. Um, but I point this history out because Harvard was really the only one doing this. And there are actually many reasons why it was structurally an advantage for Harvard to do this. The same way I would argue today that the multi-manager pods like Millennium and Citadel benefit from the ability to do some of the things that other peers can't. And so, long story short, by the time I had left, there were inklings on the wall that perhaps the political tension actually was fairly tense and that maybe the hybrid model would not last. And of course, I left, spent 10 years in a different organization. But in that time is when essentially this all unraveled. And the Harvard now, today looks nothing like that. It is actually a more closer to a classic endowment allocation model. The gentleman who runs that is a talented individual who came from the Columbia University endowment.
Columbia did a great job with their endowment. That's
yes, yeah.
Well, they all picked the hot hand, right? Harvard did a fantastic job in the aughts, and then in the tens they blew it. And it's a hot hand phenomenon, which you see quite often, right? People pour money into whichever hedge fund manager or strategies work best in the rear view mirror, and that's also when it tends to lag. But in this case, it looks like was it execution issues around this multi-manager model, or it just didn't work out, or what went wrong with the strategy?
Yeah, I would say at a high level, there were a few things that ultimately were unfortunate. One is that you have to really be long-term minded in investing endowment style. And what happened after 08 was that there was a reset towards perhaps feeling you were overexposed to certain asset classes and therefore needing to siphon them. And so when I was there, Jay Mendolo, who was the CIO that came from Wellesley, was unfortunately tasked with this incredibly difficult mission of freeing up excess cash by selling illiquid assets.
Yeah.
And private equity, and the kinds of things that ultimately had an incredible rebound, as you know, in most of the 2000s.
Right. They got whipsawed.
Yeah.
Right.
Yeah, so I think there's always this fundamental tension of wanting to be long-term minded, but needing funding for liquidity reasons, and knowing how to navigate that can actually at times feel very political. Political also because Harvard, as a public institution, has to disclose compensation models. And actually, the core reason why it could never have worked is because the disclosure of compensations at HMC was always a controversial subject. You had a bunch of different alumni who would basically say, why are these money managers being paid more than the professors who teach at Harvard?
Right. Well, students are saying that too also. And well, you get what you pay for.
Yeah, that's the incredible thing. At one point, we hired McKinsey to run the analysis of what's more cost efficient, paying 2 and 20 away on tens of billions of dollars away, or actually paying people internally at a reasonable level that you think is somewhere in the middle. But people are lazy. They don't want to multiply 2% against 30 billion and actually realize what that number is.
Right. By the way, so there's a pension, I think somewhere in the Midwest. It's run by two guys. It was run by one guy for like 25 years. And essentially he invested primarily in low cost ETFs. And he's beat his peer group of endowments, and he just hired an analyst for the first time. So that's the other side of the spectrum. And this, of course, for audience, there's like Ontario Teachers, which is considered one of the world-class pensions. Now they screwed up investing, I believe, in like FTX, but hey, mistakes happen here and there.
Sure.
And Canadian Pension Plan. But how much capital, if you can share, I don't know if that's public or not, but was decked against these multi-manager strategies at Harvard?
Yeah, it was actually less than half, but not far from it. Somewhere between like 30 and 40% at a given time. And when I was at Harvard, the endowment was about $35 billion. So it was a fairly chunky pool of capital, you could imagine, that could do some interesting things.
It's such a difficult business to run. Like Millennium, which folks might not know, I don't know the AUM now, 65 billion plus. they not only charge 2 and 20, but they push all the fees to the client as well. I mean, it is a cash machine for the owner. I used to be an investor in Millennium like 10 years ago. I'm no longer am. They create alpha. If anyone believes that alpha doesn't exist in the market, just look at the time series returns from Millennium. They only had one down year, it was 2008, and it was down 3%.
Yeah.
It was down 3%. So yes, alpha exists.
Totally. It totally exists. Now, I agree with you completely. And the question is, what is the source of that alpha? And that's where I think there's a lot of nuances that go into this. Odd Lots, actually, I believe, just did a podcast on covering the multi-manager landscape.
Yes.
Joe and Tracy are some of the brightest people in this space. I have yet to listen to it.
I want to see Joe and Tracy run like a pod or give them some capital. They got me into CoreWeave and the Brad Jacobs QXO deal. We made a lot of money on those two. And they both had 2 Odd Lots episodes. I sent them both a thank you note. And like lunch, dinner, drinks on me forever. For Odd Lots. So
I think there's also maybe like an ETF strategy that's kind of like follow Joe and Tracy's bags, and I feel like it could do pretty well. Kind of like the Nancy Pelosi ETF.
Right. You got to pick them well though, because you got to. If it's known in consensus, be careful. For example, there was one show on like GLP-1s. No, that was like a notice moment. So anyway, go ahead.
No, but they're pretty non-contrarian. I remember they actually came on to pitch copper at the right time when it was contrarian. They had a uranium episode also. So I think their purview is not too dissimilar from the interest that you and I take. But coming back to Millennium, I often joke that Millennium is an iOS. And the I there is investment. It's an investment operating system. And what I mean by that is that it centralizes a bunch of things that needs to be centralized: capital access, corporate access, risk management. And it then creates this incredibly scalable store of decentralized trading applications.
Yes.
And because of this, they have this platform-like pricing power via all the ways they have pass-throughs. And they can then carefully control the supply that comes to market. And this is the Millennium secret. Now, where does Harvard come in? Harvard actually, I would argue, is even better set up than Millennium. And here's the reason. And this is real alpha here for those who are listening. Harvard is actually a AAA rated nonprofit entity.
Yes, you're right on the mark.
And Millennium's not exactly. So Harvard actually is a better counterparty to almost anyone you could ever trade against, even better than Goldman Sachs. So you get to be the collateral manager. You get to actually manage the short book, the repos, financing to you.
Yes. No, by the way, to your point, Jeff, it's funny. So back in 2008, after 2008, Columbia Endowment had major debate on whether to use Columbia's balance sheet to borrow, because long-term rates are very cheap. And you could see that there's a yield pickup in these dislocated assets, which could be real estate or could be distressed residential mortgage-backed securities, which almost blew up the banking system in 2008. So Columbia chose not to do that. I think that was a mistake. Buffett, as you know, takes advantage of his balance sheet with the AAA rating and cheap funding. And unlike most people that are chasing high returns by focusing on high volatility assets, which we'll come back to, Buffett's focused on that high risk adjusted return on the tangency portfolio for those portfolio theory nerds in the room, and then adding a turn of leverage. And Harvard also can do that. They should. They're the cheapest balance sheet in the world.
Yep, that's right. And that's why I think maybe the Millennium model is underappreciated. The reason Millennium is able to do so many things that other multi-manager funds cannot is because they have proprietary access to capital that is priced almost exclusively cheaper than anyone else could. It sounds so simple, and yet this is actually why the moat is almost impossible to penetrate unless you come with all the right variables to compete with scale. I have a lot of respect for that business model. I think it's not a secret or a mistake that capital has been going in towards that direction, because that is structural alpha, as you've pointed out.
A great point. Yeah, it's hard to be. And there's Balyasny, there's Citadel, those are some of the other multi-manager shops, and there are a few others trying to bring that together. But if you don't have a cheap cost of capital, it's very difficult to run a market neutral book, because you've got to fund your shorts via borrowing, and every percentage point higher your funding cost goes against your net return. So let's talk about this hot ball of liquidity. right? So look, China just ramped massively in the last 2 weeks, right? David Tepper goes on CNBC and I think Becky Quick says, "What should you buy?" And he says, "Everything, like futures, stocks, bonds." Like the last time I was here was in 2010. I said, "Buy everything," and everything went up. And China has something like a 35% move. If you look at the FXI index, I checked 12 hours ago, had a short interest of 60% in that category. A lot of quants were short China as well. A lot of funds were short China as well. The carry trades that were also being funded via the renminbi, not just Japanese yen, because they thought this was like a left or dead market. If those assets aren't going to appreciate and you can fund cheaply there, as long as it doesn't move against you, you're okay. And that trade worked out for like 10 years, essentially. Some volatility in the middle, right? But now China is like down like a lot again today. We'll see what happens from here. But if I zoom out, like what I observe is that across markets, you see in digital assets, you saw parabola in May, you saw parabola in NVIDIA in June. We saw parabola in utilities that maybe ended yesterday in XLU. Utilities went up like 35%. Here's utility stocks. These are highly regulated companies outperforming the S&P 500 because of the data center. What do you make of this? First off, is there such a phenomenon out there, and how do you make sense of that?
Yeah, great question. I love this. We can talk about China, which I think is a distinct subject versus general ways people find the most topical investments today fueled by what I think is still an ongoing phenomenon with liquidity in the system. I think utilities is interesting. I actually know of a very well-regarded hedge fund that is recently raising a fund that is solely focused on what he would call scarce assets. And of course, when I say scarce asset, you might think it's a Bitcoin strategy, but it's not. There's a small crypto allocation to Bitcoin, which would make sense in that thesis, but the overwhelming majority of it is actually energy assets and utilities. And what he's trying to do is find those core patents and IPs in the ways that it could intersect with proprietary energy infrastructure that really makes it a scarce asset. And you can apply that lens of investing to public credit and equities too. So this is one strategy that I think is evergreen in the ability to bring crypto to the more mainstream dialogue. I think actually more people should be interested in thinking about crypto in that context to a larger pool of assets. So I was very happy to see this well-regarded hedge fund make a foray this way. We need more actors like this, including folks like us at Bitwise who are crypto native in the pursuit of our education research. At the end of the day, the thing about China is it wasn't so long ago that people were talking about the death of entrepreneurial energy there. I mean, I have friends who are entrepreneurs in China, and they would lament that it is over. It's over. There's no way to actually make money anymore. And politically, it's become culturally challenged. And there were all these stories about bankers, right, being cut or their salaries
being silenced. Exactly.
Oh, Jack Ma's story is old. I mean, this is really like we're talking about over the last like 12 months after the Politburo, there was this overwhelming sense of like central and command where creative entrepreneurs would be like punished for doing business here. And VC died completely. Nobody wanted to fund any more Chinese projects. And then, of course, that would trickle into tech stocks like, Baidu and Tencent and Alibaba and whatnot. So here we are in this China story where you are seeing incredible fiscal expansion towards, I think, policy, but also monetary expansion, as you've highlighted. The question is, like, are we going to then bridge the gap between the two at the cultural level? That is the question that I don't know. I think, yes, we're very excited by China's liquidity injection because overall it means that they, being the country that has mostly been exporting inflation, will now find a way to think about that in a deflationary way, is good at a global level. But you also need to ensure that the end game for China makes sense and that the growth is sustained. And I am still kind of watching for some real economic productivity there that could be ushered in away
Yeah.
from the monetary liquidity.
Well, right. I mean, the fiscal pump really isn't there yet, and uh, there's more to come. Funny enough, 2 nights ago, I shared on X this quick take from Goldman, where they say that the stimulus was insufficient,
Yeah,
and then 1 or 2 days later, markets like tank. Right?
yeah.
Is there a lesson there around memes and social investing, and what is there any connection there to this kind of hot ball of liquidity idea?
Yeah, yeah. Yes, 100%. I think in central bank policies, there's always this moment when that meme becomes powerful. We know it happens. We know that it happened in the US in '08 when Geithner was in front of the Treasury making the statements that they would backstop everything. And that was the moment that people remember. Same thing with Draghi.
Exactly.
There
We'll
was
do
a
whatever it
moment.
takes in Europe when
We'll do it.
ECB spreads in the pigs countries were blowing out.
That's right. The ultimate moment when that meme became real. I think China is not there yet. That's why I think there is going to be more efforts, and we're going to have that mimetic moment soon because I think the announced initiatives are relatively small to the scale of the economy. I agree with this. Uh, and memes are so powerful. At the end of the day, um, was it Elon Musk that had quoted that those who controls the meme basically control the world order or something to that
Hmm.
effect? And the broad statement there being, I think most of the way people think about investing is some kind of imposition of a financial primitive that you expect others to believe, right? At the end of the day, this is the great debate that I see on Twitter happening in the crypto universe about the values of meme coin trading. And the reality is almost everything in life can be distilled as a meme in some fashion, whether it's
Agreed.
gold or stocks that we believe is worth anything, whether it doesn't pay a dividend or do buybacks, but you just think it's going to grow exponentially. Those are all kind of mimetic constructions that people buy into.
Values
And I do,
mimetic. Right.
yes, yeah,
Gold is
value,
value because we believe that each other assigns value to it. And, in investment banking, of course, they call it comparables analysis.
yeah,
Like when you buy a house in a neighborhood, what's the price? Well, what are the price of the other house in the neighborhood? And is that going up or down? And then that creates the momentum effect.
yes,
So we're all looking
yes.
around and saying, what's this worth? Well, what's that worth? What did that transact at?
Yeah, I think this is the great irony too. Like when I see academics and former economists and central bank governors talk about like, oh, labor market this, jobs report that, inflation metric this, and yet it almost feels like sometimes they're missing the big picture at large as to what is driving the economy. The question being like, is the market driving the economy or is the economy driving the market? And the world that I feel we now occupy is so financialized that at times it's
Yes.
actually not clear which is the direction that has the impact. And so, you know, yes, like the jobs number last week was so strong, and now people are, oh my gosh, like we're actually gonna maybe find the terminal rate to be closer to 4% than 3.5%, and it's being priced in, right? You can see that in the Fed futures funds. Um, but what are the other things that really matter? Liquidity, right? Like liquidity actually is one of those things
Hmm.
that can come to a screeching halt at any moment in time that will change almost everything pretty binarily. And so there are three
Yeah.
things I watch too with like the jobs numbers. Um, I think the three things I would highlight is one, I watch the MOVE index pretty carefully, which is the interest rate vol index that Merrill Lynch publishes. And the MOVE index is basically the fixed income version of the VIX. But I think it's actually
Hmm.
more profound than VIX because VIX to me is a little bit of a fear gauge as to how people think about whether volatility is coming into the system or not, and therefore the cost of insurance going up with the VIX index. But the MOVE index plays a much more fundamental role in the plumbing of the financial system, which is that it affects the collateral haircut of all the bonds and
Ooh,
credit
that's
that
a great
sit in
point.
the system.
Huh. Yeah.
So if the move index is higher, then it means people can't offer as much haircut. And that immediately is retractionary into the system. So the collateral multiplier comes in. So one of the things that I've been thinking about is, well, why is Bitcoin not rallying in ways that you might expect with other asset classes? And there are
Yeah.
a few things, but this is one that I watch carefully. That I actually think the move index like coming down and Bitcoin going up is a pretty like observable correlation
Yeah.
in a
Well, I
short
would
term
just
window.
first off, I love favorite metrics and indicators. We should share a few more if you have others. We'll have to do a whole show on this. I also have my favorites too. This is fantastic. If you look at, for example, August 5th, the market bottomed on this date. The hard part is knowing the turning point, but certainly you can see some kind of peak area activity here. For April 15th, the market bottomed around April 20th, April 19th. So about a kind of a
Hmm.
5 days later, right around here when there was that right hand shoulder. And then let's see, you've got July 2nd. This is when you had obviously the kind of NVIDIA parabolic move. And
Hmm.
right now, where we are now, you've had a elevated volatility in both the equity markets and the fixed income markets. So if this is a local peak, that would be bullish.
Yeah, yeah, yeah. It was kind of treading below 100 for a while, and now we're seeing it back up, and it is going back to people's kind of jerkiness towards how they feel about where long-term rates should be. The other thing that I've watched closely is the funding rate in general. So the SOFR and Fed funds spread is an important indicator of liquidity in the system. Also the GC rate, and you saw in the last 2 weeks some jerkiness to those as well when the spreads blew out, which means that there's some kind of collateral shortage with money market funds in ways that is creating friction in the system. The other thing that I watch really closely is their reverse repo purchase agreements by the Fed. And that is essentially another way the Fed is every day involved in open market operations to take or provide liquidity.
Mhm.
And you've seen them basically injecting liquidity through these operations for almost to the point where they were going to run out eventually. You can follow this closely on Fred, but that trend line is still kind of looking like it's going down. Like it did kind of find a little bit of a footing with a rate cut, but it seems like it's still continuing on its downward path. And so, like, those are the things that I also think is equally relevant as to like jobs numbers and inflation.
This is your definition of liquidity, looking at these particular metrics. Some people look at like M1, M2, bank credit growth, ability to get financing on
Yeah.
securities, like bank term funding program that the banks had the ability to finance certain collateral. Liquidity is obviously all of those, but these are the metrics that you think are the most important for
Yeah,
financial
exactly
markets.
right. Exactly right. Yeah, there's two ways to think about liquidity. One is market liquidity, of course, right? That's that's actually the liquidity most people are familiar with. Tightness of bid offer, depth of the order book. Can I execute a trade and get it done in a frictionless manner? And that's categorically what I call market liquidity. But as you pointed out, there's a different kind of liquidity, which is the funding liquidity.
Right.
And the
Right.
funding liquidity is like how much liquidity can I get out of these assets in ways to kind of continue rolling whatever
Mhm.
yields and exposures I may have to. And the funding liquidity is perhaps like the driving force of most of, I would say, how
Mhm.
financialized our world has become. And
Yes.
it seems to grow almost exponentially year by year in ways that like it would be silly to think that the things that worked in the 90s and the early 2000s would work 20 years later given how financialized all of this has become.
Yeah, no, I agree. Look, it's the world is stacked liquidity sandwich, and on the bottom you've got the United States Treasury market, and or really the probably the overnight repo market, and when you saw that yen carry trade unwind, that's an indication of tremors in these areas. And when people don't get liquidity, and they are accustomed to getting liquidity, and they're forced to cough up assets that can create dislocations in selling. Obviously, we saw a lot of that in 2008. We had the taper tantrum when the Fed tried to pull back liquidity in the 2010s era as well. For your metrics, by the way, what are you exactly looking for in these metrics? Are you looking to check for the health of the system, or are you looking for like a general trend and the diminishment of liquidity, or what's like your trigger?
Yeah, I think it's a combination of diminishing liquidity with volatility that's increasing. And when those two things intersect, it can be very, very unstable for the financial system.
Like in
And
March
so,
COVID 2020, good
yeah,
timing.
yeah, like if you remember a few years back too, the GC rate had jumped to like 10% all of a sudden one day episodically.
Mhm.
And
Yeah,
there's been some studies done on what exactly happened that day. People blame that it was actually related to corporates having to
yeah,
pay their taxes, and that created some liquidity gaps. But like those things are highly unnatural, right? Like people should look at that event and be very like scared that like you could have an event like this based on companies just doing what they're supposed to be doing, and that causing such financial stress in the
yeah,
system. Uh, the other thing is that, I mean, I think today it's pretty clear that people are thinking about reaccelerating into growth, and inflation and those things are weighing back a bit. And the metric that I've looked at closely too is the spread between high yield investment grade. Just coming from my credit world a bit, that's an interesting thing to
it's an
monitor
excellent
because
spread to look at. That's a leading indicator, of course, for
yeah,
economic activity, right?
yeah, if you look at the option adjusted spread for those two indices and realize how tight they are, and I don't know if you could pull that up easily, Ram, but
Yeah,
it's very tight. It's super super tight, and there's also been some kind of liquidity transformation happening here too, where investment grade bonds have generally been around the same maturity, but high yield has been shortening, and so it's not truly like apples to apples to compare these yields without taking that into account. Um, but nonetheless, like that tightness is a little bit unusual as well. It almost is a little bit unnatural in itself.
yeah. This is the high yield. This is not quite the metric you're looking at. I couldn't find it quickly enough, but you see this, of course, in high yield bonds have rallied something like 8 to 9% year to date, and that's another way of measuring the credit spread versus treasury,
Hmm. Yeah,
coming in. So this is also the same. The bond market is saying that there's no recession in sight. Um,
right.
also, um, very cool. So let's go back to liquidity assets like digital assets. So you're at Bitwise. You have a Bitcoin ETF. Uh, is is Bitcoin meant to be hodled or traded?
Mm, super,
We
super
only ask the
worthwhile
hard
question.
questions here, Jeff.
um, Man,
Harvard
that's a good
Management
one.
Company on the spot. Here we go.
Yes, I think if you're a taxable investor here in the United States, Bitcoin should be a HODL asset. And the reason I say this is because taxes are a friction as well to your
Mhm.
personal wealth accumulation.
Sure.
And Bitcoin is very volatile, that if you were trying to be super clever about trading it, it means you're going to end up, sometimes being in situations where you're paying undue taxes, in my opinion.
Mhm.
So if you feel very convicted, um, for taxable investors, I do always recommend the HODL approach. Now, there are investors who believe they can earn a better risk-adjusted return by trading it, net of taxes.
Most investors will be on the wrong side of that, though, just to be clear. I think people have created extraordinary wealth in digital assets. I don't think people fully realize that. Um, but there is this process of wealth transfer to people who have skill.
Hmm.
Thoughts,
Yes.
agreement?
Yeah, I agree. I agree. I think macro investors at some level are superhumans. It's actually a good thing you've raised in how people think about hedge funds in general. Sometimes people compare hedge funds as like an average index to say, oh, hedge funds are doing bad versus passive. And they'll show like the average
The
of hedge
HFRI
funds.
index, which always says
Yeah, yeah.
terrible, lags the S&P Right.
Well, but I think the whole exercise is self-defeating because the whole point of hedge funds is to demonstrate dispersion of talent. So you can't average it. Like the top decile hedge funds and the bottom decile hedge funds have remarkably different outcomes. That's the
That's a
whole
great point.
point of
Right.
alpha. So like
Right.
why would you compare an index of anything in that context? So I think there are global macro investors who are very, very good. They're superhumans. I would call them superheroes in ways to asset
Like
management
who?
industries.
Druckenmiller, we'll put him on the pantheon. Although anything Druckenmiller buys gets bid. First
Yeah,
time I'm convinced it's true. He
yeah.
bought, of course, Nvidia. It ramped. Let me pull up Philip Morris. Philip Morris ramped, tobacco company in structural decline. It's actually got massive free cash flow, big dividend yield, and all the rest. Someone in one of our Telegram groups pinged me. So, what do you think about Molina Health? I'm like, oh, Druckenmiller owns that. It goes back to the meme idea, and people follow the leader. So, great macro investors. Who else out there that you like?
Well, I should also get a plug for Stanley Druckenmiller. You know, he's an investor in Bitwise. We're proud of
Oh,
that.
is that right?
And the thing I love about him, though, is that he's
Huh.
very quick to change his mind. Like,
Oh yeah.
there were times he was interested in Bitcoin, and then there are times he will tell you, like, it is not interesting
So
to me
he's in
right
the
now, and there's
equity
other
of
things to
Bitwise, or
focus
he
on.
owns your investment products, or like what? How is he involved?
No, he's an equity investor
Oh
of our
wow,
company.
very
Yeah,
cool.
yeah.
There's
So
Philip Morris. There's Druckenmiller, classic momentum investor.
yeah, and now he's also long China, I believe, as a trend
No,
strategy
is that
for
right? I thought he
Bitcoin.
said he'll
And
never invest in China. He said,
no, I think he changed his tune on this post the monetary expansion news flow since
oh,
two
is that
weeks
right?
ago. I believe so. I believe so. Um,
So let's
you'll have
get
to
back to your.
fact check on that though.
I'm gonna fact check you in real time here, just amongst us friends. But what is your new trend following approach to digital assets? How do you think
Oh
about that?
yes, yeah. So you're right that most people would struggle to outperform actively trading, and that's a psychological thing. Humans are really bad at making rational decisions and perhaps struggling with probabilistic distribution in general when things are very volatile. Um, oh, maybe I was wrong.
Yeah, he and David Tepper are buddies, and they respect each other. But yeah, Druckenmiller, his view on
Was it
this one.
Tepper? Maybe it was Tepper then. Somebody I
Tepper.
feel like, yeah, it was
Tepper
Tepper. Okay.
was so we track Lumina. We have a quarterly 13F tracker, and what that tracker does is it shows the top 5 hedge fund positions, the top 5 new positions, and the top 5 positions are selling for about 35 to 40 funds. And in that tracker, only 2 hedge funds had China exposure. One was David Tepper, and he had multiple different bets. And I'm
Mm-hmm.
always looking at his filings because they are truly original.
Mm-hmm.
You look at this, and it's like you can see a different kind of thinking. And the second was Michael Burry.
Mm-hmm.
But the others, the top positions across these hedge funds were Nvidia, Amazon, and the top one
Right.
holder. In fact, a lot of them, it's Mag 7 names, by the way.
Yeah, yeah.
Most of them are
Microsoft.
owning Mag 7, which isn't
Yeah.
necessarily a bad strategy. You got the ROE, you got the earnings growth, you got monopolies. Now you're getting buybacks. If you can pick them
Yep.
well, they don't own, of course, like Tesla. But anyway, so trend following.
Yeah. Well, trend following is a remarkably well-suited strategy for Bitcoin because Bitcoin demonstrates all the underlying ingredients for that to be a successful endeavor. One, it's highly volatile, and it's volatile in a way where the distribution of unlikely events, the fat tails, are larger than most assets that look like a standard log normal distribution. Um, the second thing is that Bitcoin tends to autocorrelate with momentum in itself. So when things go up, it goes up again and again and again, and it happens pretty quickly. Yes, as you can see from the chart here, when Bitcoin runs up, it runs up hard. When it falls, it also falls pretty hard, and you can know when that may happen to cut risk earlier. So the thing about Bitcoin, to put this all together, is that people have this misconception that to trade Bitcoin well is to buy low and sell high, like stocks. I mean, buying low and selling high works for stocks because you can think of that through a fundamental valuation lens when something looks cheap or rich. But Bitcoin doesn't, I would say, literally have that kind of way of framework. Instead, what Bitcoin is actually better suited for is you buy it high and you sell it higher.
Momentum.
Meaning
It's a momentum
it's a
investment.
momentum investment because
Or
you
momentum
actually,
play, to be clear, right? Up until momentum diminishes. Go ahead.
yeah, yeah. It's a trend strategy where you don't know exactly when the floor is, so you shouldn't really step into it, and you should buy it when you see signs of it ticking up that you think it'll continue. And that in itself can be very good if you want to accomplish a few things. The first would be participating in most of the upside. So you're not ever going to get all of the upside, but you're going to get most of it. And then more importantly, you get a better risk adjusted outcome because you're not going to participate in the downside as much. So your overall Sharpe ratio of a trend strategy should be higher than a Bitcoin long only strategy.
I
Now,
like that theory. Good.
the multiple of money might not be as high terminally from
Right.
point one to point A to point B, but if you're the kind of investor that cares about risk adjusted return in
Right.
a
Which
very
most should care about that. Most are not. They're chasing total return, which actually hurts their actual return. But go ahead.
right. Yeah, no, that's the key. If you're going to hold the thing forever and do it well and not give in, then I think it's okay. But as you've said, most investors struggle with this,
Yeah.
whether it's because they themselves can't tolerate it, or maybe because of the agency risk involved, and where the investment committee says, actually, I don't want this, cut it out, and you have no control over it. So most folks kind of, bottle
Committee
this up.
biases. Right.
Yeah. And so trend actually does work in crypto. There are ways to thinking about how to design it and what kinds of oscillators and signals work better than others. But the core thesis is that ultimately there are times when it's good to be invested in Bitcoin and there are times when it's not. In fact, there was a tweet that I posted some time ago that showed you the performance of Bitcoin when you invest from certain periods to certain periods. Like if you buy Bitcoin in September, uh,
The
and
seasonal effects, or go ahead.
yeah, exactly, seasonal effects, and then sell it by March, and then you just do that over and over again every year since 2011. The wealth gap is huge. Like that, I mean, most of Bitcoin's performance came in these kinds of like seasonal effects. It's a really interesting chart. And it shows you like there are some simple things that people can do to try to enhance their trading strategy that could work well because Bitcoin is such a highly volatile asset.
How do you avoid getting whipsawed? So if I go back to like the CoinDesk, I love this CoinDesk indicator, by the way. Is it general rule of thumb is like if you buy in the red, you're doing well, but that's actually a mean reversion strategy. And I also agree with your point. Like statistically, Bitcoin is a momentum asset. It's got autocorrelation, as you said, which means if it goes up, it's likely to go up again. So up until it doesn't, and then it goes down again. So,
yeah.
But how do you avoid getting whipsawed? Because ultimately, a trend following strategy is going to have some definition of trend, usually involves some kind of crossover between two, like moving averages measured at different kinds of length.
Yeah. This is the holy grail question, and the indicator that you've pulled up for CoinDesk, I believe, uses 4 different crossover signals across different durations. Some are very short within the 10-day count, and then some are longer within like the 30-day count. And they find a way to normalize each of those to come up with one tradable strength indicator. I think the view that I took is actually Bitcoin reacts probably more to the shorter duration signals than the long dated signals, especially as it relates to cutting losses early. And that's, I think, what we've been able to express
Interesting.
in our ETF. Our ETF is pretty simple. It's publicly disclosed. It's a 10-day EMA crossover signal to the 20 EMA.
What's the ticker? Is that launched yet, or you're imminently launching it? Or
No, so the ETF is actually live, and it's an existing ETF that we're reformatting the strategy for that isn't live yet. The strategy will go live in December.
So stay tuned. Stay tuned. Terrific. Well, before we transition to kind of your best practices as an investor, risk manager, trader, I think those are really interesting, from psychology to daily habits and routines. I know we both have a passion around that. What's your outlook on digital assets? And does it turn on the election? Does it turn on policy?
Yes. So I think one of the reasons why we haven't seen crypto participate to the upside with the rest of the market, despite the injection of global liquidity being at an all-time high, is the election is weighing against it. I think it's such an important catalyst that until we cross through November or feel a certainty towards a certain outcome,
Mm.
it is a little bit of a gravitational pull to resetting kind of where we are. Um, that being said, I can't imagine being better set up for crypto to experience upside in the
Why
future.
is that though? Like Bitcoin is deemed a commodity. There are no regulatory issues around Bitcoin. You have a futures product, you have an ETF product. Certainly for Ether or Solana and these other coins, there's a I total 100%, 1000% agree with what you're saying. I'm just playing devil's advocate. They're like, why does it matter? And second, if you don't get the policy administration that you want, how do you position that? Are you going to be waiting on election night with like one finger on the buy and one finger on the sell? Like, how do you approach that event?
Yeah, I think you're right. The rally you might see on altcoins and Ethereum, even particularly, is more likely to be stronger than Bitcoin on the political outcome because it impacts the developer economy more so than Bitcoin as a commodity, as you pointed out. I agree
Mhm.
with this. Nonetheless, I think there are people that are trading Bitcoin as a hedge to the election outcome as part of their
Mhm.
pairwise trading to some long
Totally
risk
agree.
exposures they may own, and
Yes.
that is
Yeah.
going back to a little bit of the mimetic world we live in, where people think Bitcoin is representing a certain outcome in the election, even if that is true or not true. And the reason I'm convicted is because ultimately, while Trump and Harris might not agree on a lot of things, they do agree on one thing, which is that monetary debasement is here to stay with growing fiscal expansion for this country on both
That's
sides.
true.
So
Yeah.
ultimately, they're both on the same side when it comes to the thesis for Bitcoin. We just need to get through what I think is a little bit of a thing. You see this with poly markets. Like you see sometimes with poly market odds affecting Bitcoin price more than it really should. And that's why I have this instinct that the election is weighing a little bit more heavily than
You
otherwise
see a
it should.
correlation between the probability of a Trump versus Harris win versus Bitcoin
Yeah,
prices.
yeah. Well, and recently it's kind of inverted, which is like when Trump's odds look higher, it almost seems like people are hedging that by kind of shorting Bitcoin against it. Like it's almost like a pair trade that seems to be taking on
So
effect.
funny. So funny. Well, look, I mean, in the beginning of the year, you had a lot of this too, or you had hedge funds that were long spot Bitcoin and then short the futures contract. And
Yeah.
I was on a panel last week at Masari Mainnet with Pranav from Vanek, and
hmm
his view was that that has suppressed the rally in Bitcoin. I don't
hmm
know if I don't know. To me, it's like backward look. You can always find a reason for why something didn't happen. It's like, well, this and that, and unless he had the view at that point in time, I don't know.
Yeah,
So,
yeah. Yeah. Well, look, at the end of the day, it's pretty simple what moves Bitcoin. It's fund flows, right? We need fund flows to
and
take
we've had
effect.
fund flows. We had this is the most successful ETF launch of all time.
Yeah,
So,
yeah.
so does that logically mean that people are selling in the spot market? Meaning on
No,
chain or Coinbase, people are saying, look, they're selling into ETF inflows.
yeah. I think it also just signifies that the on-ramp has been maybe a little bit slower than people had anticipated in really tapping into the RIA and financial advisor community,
That's
which, we've always said to people, it's going to take a little more time. It's not going to go live Jan 11th and people are going to hoard this up. But, I will say, I think Bitwise, BlackRock, we're all doing the work to get there. I actually heard from a friend very recently that one of the way BlackRock is appealing to investors that are conservative, including the pension types, is to imagine Bitcoin as part of their overall model portfolio allocation that leverages
Franklin
Aladdin.
Templeton is looking at that, right? So
Yeah,
major.
and I think
Yeah.
and I think these are kinds of the things that needs to happen to unlock more flows at this point, where we get real institutional buy-in.
So it comes down to the RIAs, the wealth management community. That's the next leg in the cycle. All right, let's shift gears and just
Or
talk about
MicroStrategy. Just kidding.
or MicroStrategy. Wow,
No, I'm just kidding.
that's a whole different.
That's another day.
There can only be one, right? There's no second best, right? It's like I crossed my Lord of the Rings meme. I finished that Lord of the Rings show on Amazon Prime. Not as good as the Peter Jackson films,
Mm.
but I can't help but think about digital gold. When you watch uh, fantasy like that. So let's talk about best practices now. Like, what are your daily routines as an investor, as a risk manager, as a trader? How do you think about that? Psychology, etc.?
Yeah. Some of you may know I started my career as a trader at Morgan Stanley. I was an exotic derivatives trader. And so,
That's probably one of the hardest
privileged.
desks at Morgan Stanley, by the way, too, right? I mean, it's
It's
like not
definitely
easy.
one of the,
It's not like the cash equities desk where you pick up a phone. All right, I'm going to take care of this for you.
yes. I would say it's the most AI immune trading desk, if there were such a thing on Wall Street. Requires a lot of judgment and discretion, and the ability to think very creatively with all the stochastic modeling in the world. So, um, I think there's a lot of studies actually now on this that's more public in the literature that wasn't before, which I'm glad to see. But so much of trading is physical. I think a lot of folks just look at models, they look at Excels and they look at charts and they think like, oh, these are the things that like make me make decisions, help me make decisions. But a lot of scientific journals have come out to say there's so much about judgment and how good traders are in control of their bodies. Um,
Mhm.
and I really do believe this. And
100%.
you have to be conscious about developing those muscles in a way that you have to recognize when your body reacts in a certain way. And only when you're able to do that do you understand like the temperament to knowing like what you can or cannot do. That's why I think people joke about like follow your gut instinct, and that sounds like you're being random, but it's not. There's actually something very scientific about your gut instinct and your
Yeah.
intuition that
Yeah.
develops over time with expertise and experience. And so the thing that I always try to share with people is like a healthy body is a healthy mind, and there's like importance of routines. They've shown that lower BMI and all those things like cater towards the ability to make better decisions in that framework. And I do buy into this.
I
So
agree. Yeah. Health of
live
mind,
healthy.
health of body, health of spirit, they all go together. You need integrity of body, mind, and soul. And you can't deceive yourself too.
Yes.
Traders and the best in the world are very honest, very sincere, very straightforward. They don't pull punches. They're direct.
Yep.
And
Yep.
a lot of people deceive themselves and they justify
Yeah.
why they're going to hold SoFi till $5 a share. I got to get a SoFi again. I'm kidding. But look, a lot of people just self-deceive and they cannot acknowledge a mistake and refactor their decision. And,
Yeah.
thoughts, other best practices, tips you have?
I think you touched on it, which is to
Okay.
be intellectually honest and humble so you can change your views quickly. I
Right.
do try to be open-minded to not being so dogmatic on everything in
It's
general in
hard. It's
life,
hard to
but
do, right?
also in
Because
investing.
you want conviction though, right?
Yeah.
You went from Stanford, Morgan Stanley, Harvard Management Company, Bitwise. So you're making a convicted bet on digital assets. You're in.
Yeah.
How do
By
you
the
change
way,
your mind, right?
maybe to put this all together, I'm not alone from the HMC days of folks who have come into crypto. I love citing my former friend and colleague from HMC who was on the fixed income desk is Gordon Liao. Gordon Liao has the most incredible LinkedIn. It actually looks maybe more unreal than
Really?
mine, which
Okay.
is that he
Oh,
went to
cool.
Harvard. He went to, I believe he got his MBA there too, but he was also at HMC. He then worked for the Fed board. So you got the seal there. And then he went to Uniswap.
Ah.
And you have this incredible pink unicorn logo that sits next to Harvard's Veritas
Yeah.
sign and the Fed shield and eagle. So but and there's a few of us also from that era that are in crypto. And so we're in good company.
Good stuff. Well, we covered a lot of ground. Any concluding thoughts, and how can folks follow you and learn more?
Yeah, the last time I checked, the Deribit options market is pricing for Bitcoin ending at 100K to be about 3%. And maybe it won't be 100K, but I've always been taught that when the odds are that good in your payout and it's combined with intense focus on people caring about certain outcomes to happen, then it's a worthwhile bet. And
So you
so
like
if
the
there's
right tail bet because the probability of that is higher than the implied probability from the options market, is your view?
yeah, like relatively speaking, for a 30 times payout, it feels like, it's
How is it
maybe too
priced? Is it
cheap.
priced well or?
Well, I think if you look at the vol curve very carefully, there's something funky where even the October month-end vol is lower than the current vol and actually future vol. This is something I was actually talking to another friend of mine on Twitter about. There's a kink in the vol curve. I'm not really sure why, but it seems weird to me that we would think Bitcoin volatility would go down 3 weeks and right before the election to something, I believe it was sub 45. So yeah, I mean that's part of the ways that people can think about trading structured payoffs to express their views on Bitcoin differently.
Fascinating. Thank you so much, Jeff. We'll have to do it again. Always a treat to hang. We covered a lot of ground here.
Yeah, this was fun.
Again. For folks that want to listen to this, you can follow us on YouTube. Go to Lumida Non-Consensus Investing or Spotify, or you listen to podcast Lumida Non-Consensus Investing. We have 1,600 live people right now, by the way. So pretty good.
Wow.
The SoFi show had like 2,200. SoFi had 2,200, by the way, which I thought was kind of wild. I didn't expect that.
Well, how many of those are bots, though?
You know what? You're right. I bet you they're half bots. There got to be a lot of bots there, right?
I'm sure crypto has their own share.
We have an inside joke because I feel like I triggered the SoFi bot army because I get these like rando reply bots that don't seem to have a human being behind them. Anyway, I think that's
they're real.
Yeah.
No, you're right.
Yeah, I mean, it's not just that company. There are at least 3 publicly traded companies, all backed by the same VC firm. I'm not going to call them out here because they're going to probably write a $100 million check for Lumida AI. So it's all good. It's all good. As long as you comply with the law, we're good.
Oh, and look, you're the AI yourself. You track them down.
Right. Anyway, but yeah, it's social media and investing go hand. Investing is a social process. We talked about memes. It goes back full circle.
Totally.
So thank you, Jeff. Until next time, take care. Be well. Cheers.
Take care. Bye.